somewhere around age 48, sometimes 49, sometimes 52, depending on how disciplined you've been. The math on your 401k flips. The tool you've been obediently maximizing for 20 years starts working against you. And the transition is invisible. There's no notification, no email from HR. The IRS is certainly not going to call and say, hey, you might want to reroute some of this. They're just going to wait for decades. And then, at age 73, hand you the bill. Here's the specific number nobody puts on the whiteboard. For high income and wealthy individuals, the biggest risk isn't running out of money, it's taxes. Saving too much in a 401k, especially as you approach your 70s, could put you at risk of large required minimum distributions. And if you're already in the 22 or 24% bracket now, you may be contributing money into a vehicle that pays it back to you later at 32%. That's not tax deferral. That's a tax increase on layaway. In a few minutes, I'm going to walk you through the RMD math that keeps CPAs up at night. But first, I want to show you a quieter problem hiding inside most employer plans right now, because it's compounding the damage in a way most people never see coming. The 401k is not a bad idea. Let me be completely clear about that up front, because this is not a conspiracy video. As of the third quarter of 2025, the number of 401k millionaires reached a record high of 654,000 individuals, according to Fidelity. The vehicle works, especially in your 20s and 30s, especially when your employer matches contributions, and especially if your current tax bracket is genuinely higher than what you expect in retirement. But the 401k has a shelf life, a specific mathematically definable point where maxing it out transitions from optimal to actively suboptimal. And most financial advice you will ever receive is structurally incapable of telling you when that point arrives. Not because your advisor is stupid, because your advisor earns more when you have more assets under management, and the simple truth that some of your money belongs in a taxable brokerage account instead of a tax-deferred one doesn't exactly help their revenue model. That's not a conspiracy, that's incentives. Amused disappointment, not outrage. Think of your 401k like a storage unit. When you first sign the lease, it feels like genius. You've got stuff you don't want taking up space in your house right now, the price per square foot is excellent, and you tell yourself you'll sort it out later. Year after year, you fill up the unit. It feels responsible, disciplined, organized. But here's the thing about storage units. You pay rent forever. And at a certain point, the government starts holding the key, not metaphorically. The IRS literally decides when you have to start clearing the place out. And the bigger the unit, the more you owe when you finally do. Every dollar you put into a traditional 401k is a dollar you will eventually have to clear out of that storage unit at whatever tax rate applies when you do. The promise was that your rate in retirement would be lower than your rate during your working years. For a lot of Americans, that's true. But for the people watching this video, the people who have actually been saving, who have real balances, who have done the disciplined thing for 2 decades, that assumption is quietly falling apart. And I'm going to prove it with math. Now, before I get to the RMD bomb, there's a problem happening inside your current plan right now that you almost certainly haven't quantified. Stay with me on this first, because it makes the second problem significantly worse. The average investment expense of plan assets for 401k plans with 25 participants and $250,000 in total assets is 1.37% of assets, according to the 21st edition of the 401k averages book. 1.37% annually. On a Fortune 500 mega plan, fees run lower, sometimes as low as 0.2 or 0.3%. But if you work for a smaller company, or if you've ever been in a plan with limited investment options, 1.3 or 1.5% is extremely common and entirely legal. Now here's where the math gets ruthless. Consider 2 hypothetical investors, both contributing $10,000 annually for 30 years, earning an average of 7% annually. Investor A pays an average of 0.5% in total annual fees. Investor B pays an average of 1.5% in total annual fees. Investor A could have approximately $930,000 in their account. Investor B could have approximately $740,000 in their account. That 1% difference in annual fees results in a nearly $190,000 difference in their retirement nest egg. Gone. Not gone to the market. Gone to fees. And you never saw it leave because it was deducted silently from your returns. A recent survey by the Government Accountability Office reports that 40% of people do not fully understand 401k fees, while 41% are unaware that they pay fees at all. Think about that for a second. Nearly half of all 401k participants don't know they're paying rent on the storage unit. They just think things are growing. But there's a layer underneath the fee problem that most people miss entirely. In a taxable brokerage account, long-term capital gains are taxed at preferential rates. For 2026, a single filer pays 0% on long-term capital gains if taxable income stays at or below $49,450, 15% up to $545,000, and 20% above that level. When you pull money out of your traditional 401k, you pay ordinary income tax. That could be 22, 24, or 32%, depending on your total income in retirement. So the tax advantage of the 401k is real going in, but all of your gains eventually come out taxed as ordinary income, not capital gains. And many employer plans are stuffed with expensive actively managed funds, which compounds the fee drag on top of the tax drag. Withdrawals from taxable accounts receive more favorable and flexible tax treatment than withdrawals from traditional 401ks. Investors pulling from their taxable accounts will owe capital gains taxes, whereas money coming out of a traditional 401k is taxed at the investor's ordinary income tax rate, which is higher. Here's the reversal you need to sit with. You think the problem is not saving enough in your 401k. For the people in this room, real balances, income above $150,000, already 20 years into the game. The problem may actually be that you've been saving too much in the wrong account. Too much ordinary income locked in a tax-deferred vault, and not enough in Roth or in a flexible taxable account where the compounding tax clock runs at 15%, not 24%. Now, I want to introduce someone. Call him Marcus. Marcus is 51 years old. He's a senior engineer at a mid-sized tech company. He's been maxing his 401k since his early 30s, disciplined, methodical, exactly the kind of person this video is about. He has about $420,000 in his traditional 401k right now. His employer matches 5%. He's proud of that balance. He should be. He did everything right. But Marcus recently sat down with a fee-only financial planner, not the advisor who manages his assets, a fee-only fiduciary who charges by the hour. And what he learned changed his contribution strategy almost immediately. We'll come back to Marcus. Stay with me, because this next part is where it gets actually surprising. I mean, I had to read it twice and then call my accountant surprising. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. The storage unit metaphor comes back because at age 73, once you reach age 73 or 75 if you were born in 1960 or later, you must begin taking annual RMDs from all tax-deferred retirement accounts, including 401k plans. The IRS uses the Uniform Lifetime Table. At 73, the distribution period is 26.5 years based on your life expectancy. You divide your December 31st account balance by 26.5, and that minimum amount comes out every year, whether you want it or not, whether the market is up or down, whether you have other income or not, and it is taxed as ordinary income. Let's make this real. Marcus is 51 today, contributing roughly $24,500 per year. That's the 2026 employee contribution limit per the IRS plus his employer's match. The employee contribution limit in 2026 is $24,500, up from $23,500 in 2025. Assume Marcus keeps maxing through age 65 and earns a conservative 6% annual return. By the time he hits 73, his traditional 401k could be worth somewhere between $1.7 and $2.1 million, depending on market conditions in those final years. Divide $2 million by 26.5. The uniform lifetime table divisor at 73 is 26.5. Applied to a $2 million balance, the first required minimum distribution runs about $75,000. That comes out as ordinary income, mandatory. Now add Social Security. Combine that RMD with $40,000 of annual Social Security benefits, and adjusted gross income climbs quickly. And here's the thing about Social Security. When your combined income is high enough, up to 85% of your benefits become taxable. So that $40,000 Social Security check is now contributing $34,000 to your taxable income. Your total taxable income before deductions is over $109,000. After the standard deduction, the single 65 and older standard deduction in 2026 is $18,100. You're sitting in the 24% bracket, potentially brushing the 32% threshold in future years as the RMD grows. You spent decades deferring taxes in the 22% bracket. You're paying on the way out at 24 or 32. The storage unit got more expensive to empty than it was to fill. And then there's Medicare. This is the part that makes the storage unit metaphor go from inconvenient to actively hostile. For 2026, IRMA thresholds start at $109,000 for single filers and $218,000 for married couples, with Part B and Part D premiums rising sharply above those levels. Once you cross that threshold, combined Part B and Part D surcharges run $1,148 to $6,936 a year, on top of the standard monthly Part B premium. And IRMA has a 2-year look back. A big RMD year today affects your Medicare cost 2 years from now. You can't unring that bell. This is the chain reaction nobody diagrams for you. Higher income from RMDs raises your modified adjusted gross income, which impacts other areas of retirement. Higher income can increase the portion of Social Security benefits subject to tax. It can also raise Medicare premiums. One account. 3 separate cascading tax consequences. At $1.2 million in pre-tax dollars, the mechanics are worth understanding before age 72. I'd argue before age 50, because that's when you can still change the trajectory. Here is where knowing these numbers and actually building a system around them are two very different things. I had the data, I read the RMD tables, and it still took me months to figure out the actual sequence, what to redirect, where, when, and in what order, to mathematically reduce the storage unit problem before it became irreversible. So I built a resource. It's a digital book called The Exit Code. 8 chapters, 50 years of actual retirement data, no filler, distilled into a mathematical framework that turns "someday I'll figure this out" into a specific date and a specific plan. 2 things in it connect directly to what we've been talking about. The first is what I call the 4% trap, the withdrawal rule that most people still treat as gospel, and the dynamic withdrawal method that replaces it. Because withdrawing 4% annually from a portfolio that's also generating forced RMDs is how you run out of money in your mid-80s rather than your mid-90s. The two interact in ways that compound sequence of returns risk in the worst possible direction. The second piece directly relevant to the RMD problem is the Social Security bridge strategy. How to delay claiming until age 70 without going broke in the gap years. Every year you wait increases your benefit by 8%. But if all your accessible money is locked in a traditional 401k before age 59 and a half, that bridge costs more than most people plan for. You can get the exit code through the link in the description for less than 1 hour with a mediocre financial advisor. The framework is yours to keep. Now back to the escalation, because here's where we get to the liquidity trap, and this is the dimension most people in their 40s haven't modeled at all. The money held in your 401k is usually difficult to access before age 59 and a half without triggering penalties. 10% penalty plus ordinary income tax on top. Which means if your early retirement plan involves stepping away from work at 55, 53, or 50, and there are more people in their 40s quietly engineering this than LinkedIn would have you believe. A 401k heavy portfolio is a cage, a very comfortable, tax-advantaged cage. But a cage, the biggest mistake early retirees make is neglecting their after-tax taxable brokerage account. It's the bridge between your working years and traditional retirement age, the account that gives you flexibility and freedom before you can tap your 401k or IRA without penalties. Let's think about this from a portfolio architecture perspective. If you are 47 years old today and you want to exit the workforce by 55, 8 years from now, you need liquid assets to cover roughly 4.5 years of expenses before you can access 401k without penalty at 59.5. Every additional dollar you contributed above the match to your traditional 401k instead of a taxable brokerage made that bridge thinner. Not because the 401k is bad, because you built the storage unit instead of building the bridge. There's a story that illustrates this better than any spreadsheet. A woman I know, call her Diane, spent 19 years as a software product manager. Smart, methodical. Maxed her 401k every single year without fail. Never set up a taxable brokerage because, in her mind, that felt less official. By the time she turned 52, she had $1,070,000 in her traditional 401k. She also had $11,000 in a savings account. When the company she worked for was acquired and her role was eliminated, she had an 8-month severance runway and then nothing accessible. $1 million in a locked box and not enough bridge to reach it without a 10% penalty plus income tax on every dollar she needed to live on. She eventually went back to work. Not because she couldn't retire in theory, she could. Because the liquidity architecture of her savings made it functionally impossible to retire at that moment on her terms. This is where Marcus comes back. When Marcus's fee-only planner modeled his trajectory, she didn't tell him to stop contributing to his 401k entirely. She told him to restructure. Capture the employer match always. That's a guaranteed 50 to 100% instant return. A 50% guaranteed instant return before a single stock appreciates. No investment on earth offers that consistently. But for dollars above the match, she redirected Marcus toward two things in order: a Roth IRA to build a tax-free withdrawal bucket, and a taxable brokerage account to build his bridge. The reason the Roth IRA matters here: RMDs don't apply to Roth IRAs or Roth 401k accounts because contributions are made with income that has already been taxed. If Marcus builds up a sizable Roth balance over the next 14 years, he can draw from it in retirement without triggering the RMD cascade. He shrinks the storage unit before the government takes the key. He reduces the IRMAA exposure. He reduces the Social Security taxation problem. He builds flexibility. In 2026, the annual contribution limit for IRAs increased to $7,500. From $7,000, that's not a lot of headroom, but it's a start. And for high earners who can't contribute directly to a Roth IRA due to income limits, those are single filers making more than $153,000, and married filing jointly making more than $242,000. There's the backdoor Roth strategy. Contribute post-tax to a traditional IRA, then convert to Roth. Perfectly legal, frequently underused, and it keeps your future withdrawals out of the RMD machinery. Now, here's a comedic aside that I cannot skip. The IRS, the same organization that requires you to start clearing out your storage unit at 73, whether you want to or not, will charge you a 25% excise tax on the amount you didn't distribute if you miss an RMD. A 25% penalty for not taking money out of your own account. You save too much, you saved it in the wrong place, and if you forget to drain the storage unit on schedule, you owe a penalty on the drainage you forgot. I find this funny. The storage unit company charges you late fees for not leaving fast enough. Amused disappointment. That's all I've got. Now, there's a new wrinkle in 2026 that I want to highlight because it's actually relevant to how you should be thinking about this. Secure 2 introduced something called the Super Catch-Up Contribution. If you're between ages 60 and 63 and your plan allows, you can contribute up to $11,250 as a super catch-up contribution in lieu of the standard $8,000 catch-up, bringing total possible contributions for that age group to $35,750 in 2026. That's a massive window of additional savings capacity at exactly the age when most people feel the most financial pressure to catch up. But here's the kicker that most people haven't read about yet. Under a new law that went into effect on January 1st, 2026, as part of Secure 2, Individuals aged 50 and older who earned more than $150,000 in FICA wages in 2025 are required to put their 401k catch-up contributions into a Roth 401k account. Read that again. Congress is mandating that high earners make their catch-up contributions as Roth after tax, no future tax on withdrawal, no RMDs. They're forcing the optimal strategy on you, which means the government's own tax architects have looked at this problem and decided people in the highest earning years should not be sending more money into the traditional tax-deferred vehicle if they're already well paid. They're legally redirecting you. The comedic cutaway here writes itself. The federal government, the same entity that created a retirement savings system so complicated it requires a 25% penalty to enforce accidentally prescribed the correct medicine insecure. 2, because they ran the same math I just ran and realized if everyone over 50 earning above $150,000 keeps maxing traditional 401ks, the future tax revenue implications get messy for everyone. So they just mandated Roth. The broken clock is right twice a day. In this case, it's right. Follow it. This is where I want to give you the framework. 3 levels. Think of your retirement savings in 3 distinct buckets. And the optimal age to stop filling the traditional 401k bucket is the moment the 3rd bucket starts making more mathematical sense. Bucket 1 is the employer match bucket. You fill this until you've captured every penny of the match. This is non-negotiable at every age, every income level, every balance. Even when you do not want to contribute the maximum to your 401k, you should not pass up an employer match. This is guaranteed free money that you cannot obtain in most other circumstances. Bucket 2 is the tax-advantaged bucket. This is your HSA, which in 2026 allows up to $8,750 for a family with triple tax advantage, and your Roth IRA or Roth 401k. These are the accounts where money goes in taxed, comes out untaxed, and never gets forced out at 73. This bucket gets priority over the traditional 401k beyond the match, the moment your projected retirement account balance trends above $1.5 million. Bucket 3 is the taxable brokerage. Taxable brokerage accounts offer complete access to your money at any time. There are no contribution limits and no age rules for withdrawal. This is your bridge account, your flexibility account, your early retirement fund. And it benefits from long-term capital gains rates, 15% for most earners instead of ordinary income rates when you withdraw. The cost is you pay taxes on dividends and realized gains annually, but you also get tax loss harvesting, which can offset gains and up to $3,000 of ordinary income per year. The order of operations for a high-income, mid-career saver who has been maxing the traditional 401k for years is 1. Always capture the match, every dollar, always. 2. Max the HSA if you have a qualifying high-deductible health plan. This is the best tax deal in the United States. Tax code contributions are pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. 3 tax advantages in 1 account. 3, max the Roth IRA or use the backdoor Roth if you're above the income threshold. Number 4, if you have remaining savings capacity, evaluate your traditional 401k balance trajectory. If you're on track for a projected balance above $1.5 million at 73, redirect to a taxable brokerage account. If you're below that threshold, finish maxing the traditional 401k. This is not the order that any brochure in any HR office in America tells you. The brochure says max your 401k, full stop. Because the brochure was written in 1989, when defined benefit pensions still existed and the average 401k balance was a rounding error, the brochure has not caught up to the math of someone who has actually saved diligently for 20 years. Now, the mini case study. Let's make Marcus specific and concrete. Marcus is 51. He earns $170,000 per year in salary. He has $420,000 in a traditional 401k with a 1.2% all-in fee rate inside a mid-size employer plan. He's been contributing $23,500 per year for the past 2 years, plus receiving about $8,500 in employer match. His plan has a decent S&P 500 index fund at 0.04% expense ratio, and a bunch of actively managed funds at 1.2 to 1.6%. He's been defaulted into a target date fund at 1% expense ratio, and he didn't know it until the fee-only planner showed him. Step 1. Marcus switches to the index fund inside his plan. Fee goes from 1% to 0.04. That single change over 14 remaining working years on a starting balance of $420,000 at 6% growth saves him approximately $86,000 in compounding fees. He did not contribute a single extra dollar. He just moved money between funds. Step 2. Marcus keeps contributing enough to capture the full employer match, about 8% of his salary, or $13,600 per year from his side, plus the $8,500 employer contribution. He stops contributing beyond that to the traditional 401k. Step 3. He opens a Roth IRA using the backdoor strategy. $7,500 per year after tax converted to Roth. That's the 2026 IRA limit. Step 4. He puts the remaining dollars, roughly $8,000 per year, that he was previously sending to the traditional 401k above the match into a taxable brokerage account invested in low-cost, tax-efficient index ETFs. He starts building the bridge. At 65, Marcus's projected numbers look like this. Traditional 401k, approximately $1.1 million, using conservative 6% return. Roth IRA, approximately $350,000. Taxable brokerage, approximately $210,000, with embedded long-term capital gains taxed at 15% on withdrawal. His first RMD at 73, based on $1.1 million in the traditional account, approximately $41,500. Add Social Security, still below the IRMA threshold of $109,000. He draws from Roth and the brokerage as needed without triggering additional ordinary income. He has the bridge. He has the flexibility. He has tax diversification. Compare this to Marcus's original path. Just keep maxing the traditional 401k and let it ride. At 65, he'd have approximately $1.9 million in the traditional account. First RMD at 73, $71,600. Social Security on top of that, IRMA triggered, Medicare surcharges, Social Security 85% taxable, no bridge, no early retirement option, no flexibility, same discipline, same total savings rate, completely different outcome. The difference is where the money went. This is what I mean when I say the smartest investors stop contributing to the traditional 401k above the match at a specific age, not because they stop saving, but because they recalibrate where the saving happens. For Marcus, that age was roughly 49 to 51, which is when his trajectory became clear enough to model. For someone who started later or earns less, it might never come. For someone in the tech sector who's been maxing a very well-matched plan since 28, it might have already come and gone. Here's the subplot resolution. Marcus ran this analysis in early 2026. He made the switch. He's not a genius. He's not some Wall Street insider. He read the tax code, built a spreadsheet, and followed the math. The math is available to anyone. The frustrating thing, the genuinely amusing thing, is that the default recommendation from every financial services product, every HR department, and every retirement planning brochure on the planet is still maximize your 401k, blanket, categorical. Regardless of your age, your balance, your income, your early retirement goals, or the IRMAA cliff waiting at $109,000, the advice hasn't changed in 30 years. The system has. The tax code has. The balances have. The advice hasn't. Many retirement plans focus on lowering taxes today without looking ahead. This short-term view often leaves high-income professionals with large tax bills later. By ignoring how accounts interact over time, traditional advice can limit flexibility and raise lifetime taxes. 3 practical takeaways before I close this thing out. First, look up your 401k's all-in expense ratio today. Not just the fund expense ratio, the total plan cost, including administrative fees and any advisor fees. Your plan must provide a 400 and 4A5 participant fee disclosure notice. If you are in a target date fund at 1% or above, move to the cheapest index fund in your plan immediately. This costs you nothing and buys back thousands in compounding. Second, model your RMD. This is not complicated. Take your current 401k balance, project it forward at 6% per year to age 73. Divide by 26.5. If the number that comes out pushes your combined retirement income, Social Security, plus that RMD above $100,000, you are building a tax problem. That's the moment to redirect contributions to Roth and taxable brokerage, not to stop saving, to redirect. Third, build the bridge before you need it. A taxable brokerage account with low-cost, tax-efficient ETFs is not a retirement account, it's a pre-retirement account. Your taxable brokerage account is where dividends, interest, and capital gains can be accessed freely. It's also where you can strategically harvest gains or losses, adjust risk exposure, and fund life's big expenses without worrying about early withdrawal rules. Every year you delay starting that account is a year of compounding you've permanently surrendered. The recurring punchline of this video is the storage unit. You want to own it when you're young and filling it up. You don't want to be owned by it when the government decides it's time to clean it out. The optimal retirement portfolio is not the biggest traditional 401k balance you can build. It's the most tax diversified, accessible, and strategically timed combination of accounts you can engineer across 3 or 4 decades of decisions. Marcus figured this out at 51. Diane figured it out at 52 after going back to work. The earlier you run this math, the fewer decisions you have to undo. Lazy investing built more fortune than crypto memes. And the irony is the boring, mechanical, stay-the-course version of this strategy requires almost no active management. It requires one spreadsheet, one afternoon, and the willingness to read your HR benefits documents more carefully than the average person, which apparently is a higher bar than it sounds.